Hello traders, welcome back. Today I had the distinct pleasure of speaking with Dr. Ernest Chan. I hope I did the show some justice, showing my ignorance, no doubt, talking to the master of machine learning in the realm of quant finance. I tried to pick his brain as much as I was capable and try to ascertain, the best steps for traders to take if they want to take a path in more advanced machine learning. A bit of a spoiler alert, what I found really interesting is how Ernie has gravitated back to, more simple causative models, relying on principles such as trend following, mean reversion, but applying machine learning in some really novel ways, particularly in his new business endeavor, which is called PredictNow, where the real advances are coming from applying machine learning to risk management, to existing trading strategies and unpicking them, assessing regimes, and just making it easier for traders to plug into his system, basically. And that's some really fascinating stuff. So if you want to get moving in the machine learning space, then you're probably going to have to learn some Python, MATLAB. That was Ernie's preferred language, or R possibly. But speaking of Python, you should take advantage of the discount that's still sitting on our website. Probably shouldn't be, for a fantastic Python for quant traders course. You should definitely take a look at that. Of course, jump on the website if you want to get access to top quality data, top quality backtesting engines, and all of that. The software that we like to use and recommend is all there. I want to give you a little bit of a background on Ernie before we start, just to let you know that he is the founder of PredictNow.ai and QTS Capital Management. His career since 1994 has been focused on the development of statistical models and advanced computer algorithms to find patterns and trends in large quantities of data. He's applied his expertise in machine learning at IBM, TJ Watson Research Center's Human Language Technologies Group, it's a mouthful, Morgan Stanley's Data Mining and Artificial Intelligence Group, Credit Suisse Horizon Trading Group, and he's also the founder and managing member of the quantitative investment firm QTS. Ernie's done a lot of educating and contributing in this space, right? So you should grab his books, Quantitative Trading, How to Build Your Own Algorithmic Trading Business. And then there's Algorithmic Trading, Winning Strategies and Their Rationale, and Machine Trading, Deploying Computer Algorithms to Conquer the Markets. And of course, there's plenty that he's got to say on his quant trading blog, and he even does workshops and has courses on his personal website. That's epchan.com. I'll mention all of these in the show notes and at the back end of the show. So Ernie holds a bachelor's degree of science from the University of Toronto, a master's of science, a doctor of philosophy degree in theoretical physics from Cornell University. He's definitely the guy to talk to about where machine learning and AI are at and how they can help us in the realm of quant finance. So let's get into the show.
Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field. We hope you enjoy the show, and if you do, please subscribe, leave us a review, or even buy us a coffee via the link on the algorithmicadvantage.com. We really appreciate it.
Dr. Ernest Chan, we're super privileged to have you on the show. Thanks so much for coming and having a chat with us.
I'm so excited. Thank you for inviting me, Simon.
Cheers. Now, look, my approach today, Ernie, if I can, I kind of want to frame this as I want to tap into your mentorship and your coaching mind, because, the initial goal that I've got is to coach the newer trader or systematic trader. And that's not to say I don't want to get more advanced as we progress with the conversation. But I'm particularly interested in, if you were coaching a younger Ernie who was just setting out on this journey, the kind of advice you would give and how to set off in the right direction, where to focus the time, maybe some practical tips on the kinds of strategies and markets and timeframes to start with. So tap into some of that practical stuff. But look, you are prolific on the internet. You've written books and you've got your blogs and you've got courses. There's a lot that you've got going on. We'll talk about your fund and your new business, PredictNow.ai, which I'm super interested in. But there will be some who don't know your background. So maybe if we could just start with that kind of maybe the short version of how you went from doing a PhD in physics to getting into quant trading, and then we'll go from there.
Sure. So, yes, actually, while I was struggling towards my PhD in graduate school, I already realized that I'm no physics professor material. So I fortunately developed a different interest, which is really machine learning and AI. Those were early days. It was in the 1990s. So it was certainly not as hype as nowadays in AI, but people were very much aware of it. So I got a job not in physics but in AI after I got my PhD, and thankfully, after getting 99 rejection letters, I finally got one acceptance letter. That's from IBM Research. So that's and in the language modeling group, which was quite high profile at that time. So I was very lucky to be able to switch career at that point. And that group turned out to become quite well known in asset management circles because two of the founders of that group left and later on became co-CEO of quantitative hedge funds called Renaissance Technologies. And I never met them because they left a year before me, but they did recruit a lot of my colleagues who went over there. So I, after a few years, I got curious myself, and I made a decision to, also got into the financial service industry by joining Morgan Stanley's AI lab, which was just starting at that time. Investment bank was just coming to this new territory, new tool called AI, and that's how I finally got into finance proper.
Yeah, Jim Simons, I guess, had a bit of an influence on a few people in your era, I guess, by starting Rentec and recruiting people and getting physicists and mathematicians interested in the markets.
That's right.
Nice. All right. So you've had a lot of experience since then. You've got the fund. You've done a lot of things. We'll talk about that later. So going back to my first point, then I guess if you were talking to a new trader, so someone who's familiar, with the basics of systematic trading, the first question I've really got, I guess, is a lot of us are familiar with standard optimization techniques and techniques for robustness testing what we're doing, but we're really just doing a lot of brute force optimization. If we're going to apply, some more advanced machine learning techniques, what's the sort of first thing that we need to get educated on and understanding the differences between moving from just basic optimization to, into deeper machine learning? What are some of the categories of machine learning and what are some of the first steps in moving in that path?
Yes. So in, traditionally, a lot of asset managers are aware of two kinds of machine learning technique. One is supervised learning. Essentially, you present examples of inputs and example of predicted output, such as future return, and you train the machine learning system to predict the output given the inputs, which is a very much a glorified linear regression, except the algorithm may not be linear. It's just non-linear. You can call it non-linear regression if you like. You can use something as complicated as a neural network to do that, but that's still just supervised learning. But there's also another kind of machine learning called unsupervised learning that many asset managers are familiar with. Things such as clustering. So, for example, what is the best way to cluster stocks so that you can perhaps treat them similarly, or put them in the same portfolio and run a long short strategies against them. Or there are even things like hidden Markov model, where people are assuming that you have some hidden regimes, and but since they're hidden, you can't really see them, so you can't use the explicit regime labels to learn from. So you have to infer that from the outputs, which is the observable returns. And the question is, does this hidden Markov model make better prediction of the returns? Does it model the probability distribution of returns better than if you assume that there's no hidden states? So these are all examples of unsupervised learning, and many asset managers have been familiar with them for decades. Now, but in recent years, there are two new techniques that became very popular, and many more asset managers are more familiar. So for the first one is reinforcement learning. Reinforcement learning assumes that for example, portfolio optimization is one example that you can apply reinforcement learning to. You are trying to get higher Sharpe, where everybody was trying to allocate asset to your portfolio that you can get as high a Sharpe as possible, or you want to optimize the parameters of the trading strategy to get as high a Sharpe as possible. But there is, literally sky's the limit. What is a high enough Sharpe? You simply try to maximize it. You're not saying that, well, you should learn to have a portfolio that has a Sharpe of 2 or Sharpe of 215. Well, why not 3? Maybe there's a portfolio with a Sharpe of 4 that you haven't looked at before. So the goal of reinforcement learning is really optimization, is maximize the reward of some sort. In portfolio optimization is Sharpe ratio. And that, of course, reinforcement learning has been used very successfully in other areas of applications, such as, playing Go, right? So now we realize that the machine can beat any human playing Go, and that was the result of reinforcement learning. And also, it was used very spectacularly successfully in, for example, training a language model or fine-tuning a language model, such as ChatGPT. You use reinforcement learning with human feedback so that it will learn to output sentences that a human would deem more suitable. And of course, there's maybe you never have an example to learn from because you can be just like Sharpe ratio, there's always a better sentence you can output, but you can use this reinforcement learning to force the language model to become as good as possible within the training time allowed. And so that's because reinforcement learning is essentially a optimization technique. And a lot of trading strategies, optimization and portfolio optimization fall within it. So a lot of asset managers become familiar with that technique as well. But in recent years, also generative AI also entered into the vocabulary of a lot of asset managers. What is generative AI, and how is it different from all this other stuff? Generative AI essentially is a complicated way to model the data, the probability distribution of data, before you ask the data to do anything. So if you are a Bayesian, you might call it, well, you're trying to create a good prior of the data. Or if you are, in the case of finance, the goal might be to create a model of the distribution of returns of all the stocks in the universe. And the question of, so what do you want to use this probability distribution for? That's secondary. We'll look at the downstream application. But the goal of generative AI is really to build this probability distribution in high dimension, because of course you have let's say 5,000 stocks you want to model, and they all are not independent. You can reduce it to a one-dimensional distribution. They all have, codependence. When Google move up 10%, most likely Microsoft is not going to be far behind, or vice versa. So they all have codependence, and you need a high-dimensional distribution to model them. And generative AI is a way to model these things efficiently, and not just with a the traditional, let's have a Gaussian multivariate Gaussian distribution with some correlation. No, that's the first approximation. But generative AI are able to model them with a vastly more inputs, perhaps inputs that are not just based on return, but based on other aspects of the market or economic indicators and so forth, where we have built this good representation of this high dimensional distribution. And then once you have that distribution, you can then use it to answer the question, which is, what's the likelihood that Google is going to go up if Microsoft is going up, or what's the possible 5-day return? Those questions, there are any number of questions you can ask once you have this generative AI model, this high dimensional distribution, pi distribution. So that point of view, it is becoming, much more adopted. Is more widely adopted by asset managers as they become familiarized with this point of view, which is popularized really by people who are building language models, but it's actually fundamental than just using it for language modeling.
Yeah. So, Gen AI, reinforcement learning, are these other categories of machine learning? Like when we talk about, the terms that I know little about, deep forest, deep learning, shallow learning, neural networks. Can you explain some of these terms to give me a bit of a landscape of the options in machine learning? Are we talking about just different ways of modeling?
Oh, yes. Well, there are many different techniques, of course, in machine learning, and they can be, within the 4 category of machine learning, namely supervised learning, unsupervised learning, reinforcement learning, and generative AI. Within each, there are, many different techniques. So let's start with supervised learning, which is what most asset managers would be familiar with historically. You would have, linear regression would be the first thing that people think, or generalized linear model, which essentially is a linear model, which essentially is a function of linear models, right? And then you have, you can have piecewise linear model, which some people will think of as regression trees. Classification of regression tree is a kind of a piecewise linear model, or hierarchical linear model, you might call it also. And then there are more kernel-based techniques such as singular value decomposition, which essentially you are trying to first put your variables through a nonlinear transformation so that it becomes easier to discriminate between 0 and 1. Right? If you don't put them through this nonlinear function, the 1 and 0 classes are all mixed up. But miraculously, once you put it through this kernel function, there's a nice decision surface that can much easier cut them into 2 classes, discriminate between the 2 classes. And then of course, finally, there is the neural network. So neural network is basically a network of nonlinear functions. But the component of a neural network can be very simple. It could be almost like a linear function, except that, for example, ReLU is a function that is flat up to some threshold and then suddenly become a linear function. That's the basic component of a neural network. So that is for neural network, there are many variations. You can be you can have a straightforward multilinear multi-layer perceptron (MLP). You can have a recursive structure such as recurrent neural network. You can have a structure that is best for capturing nearest neighbors, such as a convolution neural network. And you can have a network that have attention. You can have so there's all kinds of architecture. Once you have a network, you can build any kind of architecture. But they're all basically different techniques of supervised learning.
Right.
Outside of supervised learning, for the unsupervised learning, you have many different kinds of clustering techniques. And, in terms of, like, for example, things with hidden variables, such as hidden Markov model or Kalman filter, you have many training algorithms to discover what this, infer what the hidden state is. EM algorithm, expectation maximization algorithm, which is widely also used in speech recognition, has been used a lot in this kind of situation where you have a hidden state that you cannot actually see, but you can, however, if you have a model, you can infer them, and then if you infer them, this hidden state will output some visible effect that you can also use for your training. So, these are the supervised learning technique. And then the reinforcement learning is a very complicated subject. There are many algorithms to perform reinforcement learning, but one of the more popular algorithm, particularly when the variable that you want to optimize is a continuous variable, such as asset allocation, is called proximal policy optimization, or PPO. So that, it's essentially using a neural network and to approximate the output probability distribution of a particular action variable, and that action variable might be the amount of capital to rebalance, or it could be the position size of different stocks and so forth. So that's one popular technique. And then finally, in the case of generative AI, there are numerous techniques to how do you get to from a vast amount of input to a latent sort of representation of this kind of high dimensional space. There's things such as variational autoencoder comes to mind, and flow model and so forth. I'm certainly no expert in generative AI, but my co-author of our book on generative AI has a chapter on practically every single important technique in Gen AI that we have introduced these techniques. But the subject is truly fast. I myself have to read it 4 times of what was written to get a barely a superficial understanding of it. So it's a part.
So apart from reading the book, which obviously is going to be one of the first steps, is there software out there, Ernie, that traders, systematic traders, can get their hands on that provide sort of maybe low code solutions to this kind of thing? Or does this process have to be built up from scratch using Python or R or MATLAB? There's obviously, libraries and tools out there. How possible is it to, read the book, get a selection of various software tools, and I know that preparing the data is obviously a huge part of this. If we're going to build, systematic trading models, there's a lot of data preparation, but that's something that the listeners might be a bit more familiar with. So if we assume that, okay, we've got to prepare the data, are there tools out there that we can get our hands on, maybe some retail software packages, where we can start, inputting that data and starting to run through, a reinforcement learning process, or is this still, a really difficult endeavor?
Well, all of the techniques I described above are already implemented in various libraries. But to use this library correctly is also not a simple matter, because they have enormous number of hyperparameters that, and, of course they have defaults, but in certain situations you have to change them. And so, one still have to have a sufficiently in-depth understanding of the technique before you can even use this library, because of the large amount of hyperparameters present. but no one would dream of creating a decision tree algorithm from scratch. No one would dream of creating a PPO library from scratch. No one would dream of creating a generative adversarial network, libraries from scratch. They are implemented in multiple places, typically from places like Meta or Google or Microsoft or OpenAI and so forth. So, or even aggregative sites such as Hugging Face. There are many of these examples libraries. So I think there are thousands of computer science students out there that are using this program to try to trade. However, that's just because you have this algorithm doesn't mean that the trading strategy works, because every other computer science student know how to create such an algorithm. The problem is that as a result, all the alpha has been arbitraged away already. If all you want to do is to apply standard algorithm and apply to data, well, that's so easy that any number of hedge fund, any number of computer science students would have done that already. So I would say that machine learning is in the case of asset management is much more difficult than just running standard algorithm on data, and for that very reason. In other areas, such as, let's say, you want to optimize shipping schedules of container shipping, or you want to optimize operation of a production chain or something, there's no such a thing as arbitrage. So, if you optimize something, great, all the power to you. But in finance, that's the opposite. Yeah, you might work on the problem historically and it worked very well. Well, the problem is that there are about $100 billion out there that are also working on the same algorithm. And, by the time you actually trade live, everybody's trading in the same space and there won't be any alpha left. So, in trading, I think more often is that you need to constrain the model severely using very high level insights. And this insight can only be gleaned, for example, from fundamental understanding of the market and the arbitrage opportunity, and know when these opportunities will go away. So a lot of times, you observe a market and you say, well, there's this opportunity. You have to understand why there's this opportunity, and when this opportunity will go away. Because if the machine cannot understand at this moment the high level reason why the opportunity exists, they only know that they might discover that it exists, but they could not find the reason. They did not understand the reason that they exist. So when the causal, the cause of this opportunity disappear, the effect will disappear as well. And the machine learning algorithm was usually unable to understand that when that cause is going to disappear, because they don't understand the cause. So we are also always try to look for some kind of causal model. Many people would put it. You see an arbitrage opportunity. What's the cause of that? And to discover the cause, sometimes you can scour the internet. You can Google all you want. You can use OpenAI, ChatGPT, and so forth, and you couldn't find the cause, because the cause exists only within a very niche of the market. Some people who have, for example, let's say you are a quant trader, and the reason you're good at quant trader because you have worked in a physical quant company, and all the knowledge that you get from processing quant tells you this opportunity. And as an outsider, if you never really work in the industry, there's no book that you can easily find this knowledge. These are all institutional knowledge, closely held secrets, closely held bags of tricks that maybe only exist in internal document, and other times only exist, orally, verbally. It's almost back to the prehistoric age where all this knowledge was passed on verbally. There's no written record of it. and it's passed on within the family or within this corporation. And so how are you going to learn from that knowledge? Unless you are actually as a participant in that industry. So I find that that is where a lot of the arbitrage opportunity come from. That not easily learned by reading.
Yeah. So this so this takes us back to where I wanted to get to, stepping right back then to some of your earlier experience where, you've done a lot of work in machine learning techniques, and you circled back. I've heard you talk about how you shelved it for a long while because, the progress wasn't really being made there, and you came back to these more causal models and simple models that made a lot of sense. So if we start back there, if you're giving some coaching advice now to someone who's just starting out, if you were starting again now and you just wanted to get some models working and you wanted to be on the right pathway to extracting, consistent, robust methods of extracting alpha from the markets, but you're starting simply, are there particular markets you would say to that person, look, start here, maybe start with these models, start to get your head around things and then progress from there?
Yes, I think that it is, I think, key to start with simple models, and particularly key to start trading live as soon as possible. Because endless backtest is usually not going to get you anywhere. From my experience, you have to start really interacting the market to gain insight. Again, it's like taking us to the prehistoric age, right? So if someone, tribe leader teach you how to hunt animals, you get talk for hours on end, and you would not learn how to hunt animal unless you go out and hunt them. Once you start chasing after animal, you get bitten a few times and maybe set a trap, fail to set a trap a few times. That's where you learn certain nuances about the animal that you cannot find in the lecture given by the tribal leader. You cannot find it in any written pictograms and so forth. Right? So you have to go out and hunt. That's the same way with trading. A lot of times is that you can read all you can backtest all you can, unless you trade live and get pummeled by losses. You would not get an intuition of how certain cause and effect happen in the market and whether you can detect them, because there are just so many moving parts. So I definitely recommend the first step is to find something simple that you think will work and try it, and if it doesn't work, find out why it doesn't work.
A preference for trading, say, equities or futures?
Well, that is a really matter of personal taste. Some people find that they can understand the behavior of stocks better because they perhaps have a accounting background, and they understand that, hey, this company, look at this particular fundamental variable, looks like it's won't be keep doing well, and so short this company. As you hear, there are all these short sellers that are really study the company in depth, right? They can even do forensic accounting and discover that, oh, this is just a house of cards. It's going to be exposed soon, and so they short it and publicize their analysis. So these are people that obviously they won't succeed very well if you ask them to trade the euro yen exchange rate, right? But certainly you apply them to studying companies, they will do very well. On the other hand, there are people like George Soros that they have a macro understanding of how the world works, how the central bank action will work, how the debt of a country will work, how economic growth and inflation, all these big themes that would affect the macroeconomic factors. Well, they should definitely trade, rates, or they should trade exchange currencies. So it's really what you should trade is really based on your own interest, your background, your understanding. If you have a very quantitative background, maybe you should dive into options, which can be modeled with higher mathematics. If you are a CFA, you should maybe trade stocks. If you are an economist, macroeconomist, you should trade futures, rates, and other stuff. So it's very much, and for example, there are people who like to play poker or play cards, and those people apparently are very good at trading options because options oftentimes have binary outcome, very similar to gambling. Whereas in stock, hey, it's infinite amount of outcome. You can make 10 basis points, you can make 50 basis points, you can lose 10 basis points. It's like the outcome is continuous. Whereas in option, oftentimes, you either make the premium or you lose the premium. It's very simple. And you expire in the money or out of money or whatever. And if you expire out of money, and you long option, you get zero. So it's very simple. So for that kind of instruments, oftentimes people who are familiar with poker or familiar with any kind of card games might be best suited. So I think that what you trade is really dependent on your personal.
What about time frames? Obviously, there's a lot more noise in the smaller time frames, commissions and costs. Slippage can take more of a chunk out of your trading, and you can go all the way at it to sort of trading some long-term models and tactical asset allocation, ETFs, rotation. Do you think it pays to start with something, simpler and longer term, or not necessarily?
Well, from the retail trader point of view, oftentimes it depends on if you are doing this full time or not. If you're doing it full time, you can definitely trade intraday and monitor the market, or at least monitor the program that monitors market, on an intraday basis. But if you are doing this part time, all you can do is to check the market before you start working, or after you finish working. So obviously, intraday trading is out, daily trading or swing trading or even longer term investment might be much better use of the time. So the advantage of short term trading, if you have the time to do it, is kind of ironic. If the shorter the time the trading, the more time you need to pay to that endeavor. So the advantage of that is high Sharpe ratio. So high Sharpe ratio enable you to finish your experiment fast. If your trading strategy doesn't work, you'll find out pretty quick. If it works, you'll find out pretty quick. Whereas if you have a low Sharpe ratio strategy, which typically happen when you're holding for weeks on end, because think about it, if you hold something for weeks on end, it's your daily P&L are kind of at the mercy of the market, right? If you're long, maybe eventually you make money, but you can hardly prevent the market going up and down in between. It's not your fault, but that's unfortunately that's what the market do. So your Sharpe ratio is going to be low, and because the Sharpe ratio is low, you will need a much longer time to test your strategy to find out if it actually works. So that's the disadvantage really of holding. But on the other hand, holding longer term, besides the fact that it, you don't have to monitor it so closely, has the advantage that you can take, it has bigger capacity. I mean, of course, that's not a concern for retail trader, but if you're an institutional trader, capacity is a big issue, right? If you want to grow your fund to a multi-billion-dollar fund, obviously you don't want a strategy that can only hold 100 billion, and run out of alpha. So, so I was saying that there are many factors that determine what horizon of trading holding that you want to do.
You've talked publicly about a black swan event that occurred when you were trading mean reversion strategies early on, and how those negative skew strategies can cause a great deal of damage. If one was trading, do you have a preference? I take it you don't, but if you're trading trend following strategies, you've got to apply certain risk management techniques. If you're trading mean reversion strategies, and you've got that negative skew, capability, then are there particular risk management techniques that you would apply to guard against that now? What have we learnt from trading these negative skew strategies?
Well, I think that certainly I had expressed the opinion in my books that a mean reversion strategy should not have stop loss, but that is only true to the extent that you can afford to lose a lot of money in the interim. Sometimes your mean reversion strategy fail because the model has broken down, and to prevent that from happening, you definitely need a stop loss. So I would say stop loss is one defense, but of course there are markets there's trading strategy where you hold overnight and hold over the weekend that the market is closed, so stop loss won't help you in those cases. In that case, you really need to implement options. So one way of protecting yourself from catastrophic loss of a mean reversion strategy is that you have to apply options to insure against these losses. So yeah,
I guess I'm going to just keep moving with these themes so to make sure we cover as much as possible. But I guess if we're talking about that hedging protection, option protection, you've obviously spent a great deal of time in your fund on the strategy called Tail Reaper, which I understand is essentially a long vol strategy that's there to protect in adverse market conditions. Can you talk to us a bit about the kind of model that is, and is it just a sort of quote unquote hedge, or is it designed to also potentially make money, through standard regimes, or how do you otherwise avoid it bleeding too much during the good times? Like what are the basic components of this model, and what are you trying to achieve?
Well, the tail reaper strategy is a intraday momentum strategy, and like you said, it's therefore because it's a momentum strategy, it's long volatility. Although we only trade the S&P 500 index, right? So we don't trade options. So it nevertheless it achieves long volatility property because of trend following. Now, and it is also a causal strategy, which means that there is a reason why it works.
Is it long and short, or just short?
No, it's both long and short on different days. There's a cause for it, and the cause for it is many people call it is the force rebalancing, when people are short gamma. It is you are forced to rebalance at the end of the day, and that causes the momentum of the associated futures towards the end of the day. If you let's say the market is going very high during the day, and the options market makers are all let's say they are short calls, they've been selling calls or to the buyers. Well, they need to, towards the end of the day, need to keep their exposure, or to be delta neutral. So all of a sudden they need to buy a lot of stocks in order to neutralize that delta. Well, that forces the market to go up. So there's this phenomenon to call force rebalancing that we are trying to capitalize on using this strategy. It's no secret. I mean, this has been published by numerous academic papers, but it still works because there's a cause, and this cause remains there. You can't get away from it. That's the beauty of the causal strategy, is that as long as you know that the cause can't disappear, the effect will be there. Now, the causal relationship, however, is a noisy one, because there are, of course, other factors that can affect the market. The market is never driven by one factor. There are many other factors. And so the question is, how do you design trading rules and design risk management layer where you can avoid getting the signal overwhelmed by other factors? And one way we do it is via machine learning. So we impose a machine learning based risk management layer on top, which has many inputs in this machine learning. Remember, the causal model is fairly simple. Trend following. How difficult is that? Is there a trend? Well, if so, follow. But the risk management layer, however, is very complicated because it will try to find as many factors as possible that would derail this basic cause. And that is really the first successful application of machine learning that I have found. As we discussed earlier, a pure machine learning approach to finding alpha has not been fruitful for us. Maybe it worked for other people, but for me personally, it hadn't worked until so far, let me say.
Yeah, well, it's not like the evidence there. It's not like there's a lot of evidence that the ML and AI driven funds are dramatically outperforming. I mean, Rentec is the one exception, I think, but we're not really seeing that.
I don't know if I would characterize Rentec as a machine learning fund. It has been a lot of misconception that just because some of the portfolio managers or some of the, in fact, the co-CEO came from machine learning background, that all, necessarily is so-called an AI-driven fund. My understanding is that at least in the beginning, when my colleagues joined it, it was not an AI-driven. It is a traditional statistical arbitrage fund or high-frequency trading fund. And remember, these people who joined Mantec in the early days are not just good in machine learning. They are mathematicians. So they are very versatile. They have many tools in their tool set outside of just strict machine learning. Yeah. So I actually don't think that is correct to characterize Mantec.
Okay, good point.
But you're right. Yes, there's no strong evidence that AI funds are, superior. And the reason is, like I said, AI, if you're using a generic AI technique and, applying on the data, everybody have the same access to tools. Any high school student nowadays know how to do, random forests or neural network, no big deal. And the data, well, if you're applying it to daily data, well, everybody have daily data, go download from Yahoo Finance. Well, of course, if you're talking about high frequency trading, well, that's where the edge is, right? High school student can't afford microsecond frequency data. So that's where some of the institutional advantage are maintained. But yeah, you don't need machine learning for that in general. In fact, at the microsecond frequency, if you have to rely on a machine learning algorithm to generate trades, usually it's too late because it's too complicated. You need fast decision making at that level. So, however, as risk management, we can get complicated. We can get fancy. The reason that AI can work in risk management is because when you're talking about managing risk, everybody's risk is different. In our case, we are managing risk of our trading strategy, which no one else is trading. Well, maybe they are trading their own version of tail ripper, of course, and we don't claim to be unique. But the fact is that the risk management usually means not trading on certain days. That's all it means. It doesn't mean, let's start trading earlier or later. That doesn't mean that. It means not trading. That's usually what risk, or trade less. That's what risk management means. Well, for that, you are not competing with anybody. You're trying to say, stop, don't do it. But, if everybody says, let's not do it, that's not going to affect, your trading strategy, because everybody trading a slightly different strategy or very different strategy. So risk management can still work. I mean, AI can still work in risk management. That's why we find it to be first successful use case.
So again, dovetailing, trying to pull all these bits together. The advice to the newer trader might be to have this design-led approach that, you've circled back to, these causal strategies. We've talked about the corn grower, farmer having inside information, the oral tradition, if you like, that's giving them an edge. We've got causal strategies in play. We're tapping into basics such as mean reversion and trend following techniques that are time tested. We know then it's all about risk management. So the key here is that we can start to use some of these ML techniques in the risk management process. Maybe this is an opportunity to talk about PredictNow, but tell us about how some of the basic first steps of using, ML techniques in risk management or other aspects like position sizing or portfolio allocation, whatever it might be.
Well, I mean, like I said, usually we apply machine learning layer to predict whether a strategy will be profitable on that day. Well, for us, it's easy because our strategy is an intraday strategy. So every day we liquidate it at the end of the day. So you can treat it as, every day is a new strategy. When you have a strategy where whole multiple days become more complicated because you might not want to decrease the position size when you already have it. Right. So, but in our case, every day is a new position. So we can choose our size as we see fit every day. And so with the probability of profit, that's what the machine learning system is computing. Probability of profit is high. You can allocate more capital. If it's low, you can allocate less capital or even zero capital if it's low enough. So that's a basic risk management scheme based on machine learning. And then there is another technique, which is for capital allocation. So we have, two strategies, and we use machine learning to allocate capital between them. And again, that the input to that allocation could be macroeconomics factors, could be, global financial markets information, or whatever. We have right now we have 600 plus factors that we created at PredictNow. You can use some or all of them as an input to this allocator. And we find that, obviously the back test, we find it work. And to my pleasant surprise, it actually outperformed a naive allocation, let's say 50-50 allocation. It outperformed that in live tradings for more than a year as well. So that's another application, risk management and capital allocation.
So what we're talking about here is just give us a bit more detail there. So the magic of this new process, if you like, of using machine learning is to actually feed in not just the trading algorithm, but your actual trades. So one could PredictNow can analyze. I could upload. Correct me if I'm wrong. I could upload my actual historic trades, and then you could take these 600 factors and apply them to the outcomes of each of those trades, and we can start to get a grip on the, I guess, conditional probability of the success of these different trades, and therefore try to unpack the regimes that are defined by these 600 additional parameters. Say, is that what's going on? We're trying to actually sort of get a model for regimes of when our models work and when they don't work, and that gives us the ability to either put our foot on the accelerator or on the brake at certain times.
Yes, I think a regime is a good way to understand it, although this regime is different from what normally you understand it. Normally people understand regime as a sort of dichotomy, the binary. It's a bull market. Oh, now it's a bear market. Oh, this is high fall market. Oh, this is low fall market. Well, to us, regime is defined as a point in a 600-dimensional space. What do you mean by regime? Oh, its volatility is low, but interest rate is medium, and economic growth is medium, and but Japanese yen is low, and Chinese economic growth is high, and whatever. So there's 600 measurements of the so-called regime. So essentially the regime is one point in the 600-dimensional space. And so we are trying to use this high-dimensional space to understand your return. Now, we don't actually need to know your trade. We don't even know what you're trading. All we need to know is your historical returns, daily return of the strategy, let's say. I mean, it could be 5-minute bar return as well, but the problem is we don't have a lot of indicators that vary every 5 minutes. So, economic numbers, might vary once a month even. So, we settle on daily returns as the input to learn from. So we say, well, your strategy, it seems like when the regime is at this point in the high dimensional space, your return typically are pretty good. And then when this regime is at this other corner of the 600 dimensional space, your return suddenly skew negative. And that's where we learn to assign probabilities to your strategy of being profitable, is where this current regime is, where this little point in the 600 dimensional space is sitting.
That's fascinating. I guess that's almost like my earlier question of like, is there an off-the-shelf package that we can plug into to take advantage of some of these things? Well, it sounds like PredictNow is moving in that direction, right? It's a tool that I can utilize to add some really expansive machine learning techniques to what I'm already doing.
Yes, actually, PredictNow has implemented this as an API, so traders can access it. But a lot of times, there are some nuances. So, for example, we might, if you have a portfolio of stocks that you feed into this algorithm, and one day we might say, well, whatever you're long should be short, and whatever short, or should be liquidated. And so, some people, as a manager, will say, well, I can't, because we got too much in one stock. We can't just trade in and out of billions of dollars every day. So they would have to have extra constraints. So a lot of times when we work with large, asset managers, they like to impose this kind of, turnover constraints. And that's where it gets complicated. So the API works if you don't have these constraints, but if you have the constraint, we will have to customize it, appropriately.
Awesome. Just going to fire all the ideas that come to me as I think of them as we start to wrap up. And then I've got a couple of questions from listeners that I really don't want to forget to get to as well. In all of this, there's still a lot of data. There's still a lot of points that we're optimizing on. What are the principles here in terms of how you would, again, suggest to the younger Ernie how to avoid data snooping? This is one of the biggest problems, if you like, that we're all facing. So are there some practical techniques that apply in this landscape to, some principles that you've developed in terms of how to create robust models without overfitting?
Well, again, if you start from a, causal model, you are hypothesizing. So causal model sounds, fancy. What is that? Well, that's what the way people have been doing scientific research for hundreds of years. All the sciences have been building causal models. Physicists, chemists, biologists, they hypothesize, okay, smoking causes cancer, or, being exposed to malaria will shorten your life. Eating too much cholesterol will increase your risk of stroke, let's say, right? So these are causal models. Now, you propose, smoking causes cancer because of this and that chemicals. And you say, well, how do you prove it? How do you prove it? Well, you don't prove it. You prove it by, determining if the reasoning is correct. You're running experiments to see, well, if I remove this chemical in the cigarettes, would that still cause cancer? No, it doesn't. So you have this, A/B test in e-commerce, you might call it, or in medicine. Obviously, you can perform similar tests by removing a cause and see if the effect is still there. And usually it's not there. Then you have proven your hypothesis. It's called causal inference. And so in trading, you can do the same. You say, well, I believe that every time the Fed lower the rate, it caused the market to go up because of the fact that people are less risk reverse because of the risk premium is lower. So you say, oh, well, that's easy. What about let's say if the Fed doesn't lower rate, does it also perform like that? Well, it doesn't. So you form a hypothesis and you look for data to reject your hypothesis. That's like the scientific method. And so that is not data mining, because data mining means that, well, I don't have a hypothesis. Let me just go through the data and look for patterns in the data. And then maybe we'll form a hypothesis. Well, that's kind of going backwards. That's not how science is done. That's like looking for blindly the effect and then looking for the cause through this potentially coincidental relationship. That's not how science is done. So that's how causal modeling can reduce, not eliminate, but reduce data mining and overfitting.
That's a great point.
Actually, causal reasoning is a big sort of research direction for language models. They want to teach, have language models learn how to do causal reasoning. So at some point, I wouldn't say that causal reasoning is the sole domain of humans. I'm sure AI can also learn to be, find causes. So, but nevertheless, the methodology itself is what's important. So even when the cause and effect are discovered by AI, it doesn't mean that the data mining is not invalid. It's just that AI has learned to reason like people and form hypotheses. Yes.
How do you tend to discriminate when using the words AI versus ML?
Well, in the old days, machine learning is one kind of AI. The other kind of AI would be expert systems. What's expert systems is a rule-based system that essentially an expert, human expert, define these rules, and a programmer go and co-op all the rules, which is what most quantitative trading strategies are, right? Moving average, RSI, whatever technical indicators. The trader said, well, when RSI is greater than this, short and long, smaller than long, long, and so forth and so forth. So those are expert systems. Most trading strategies are expert systems. And, is it intelligence? Well, the intelligence comes from the trader, not from the machine. Come from the program, maybe you can say. But people call it AI, right? For lack of a better term. It looks like the machine is very intelligent. Little did they know that the intelligence actually comes from human. But then there's machine learning where no one teach the machine that RSI greater than this threshold, you should long. The machine goes look through the data and discover this rule by themselves by looking at different level of RSI and then the corresponding future return and discover that, at this threshold, more likely than not is positive return. Well, that's machine learning. The machine automatically discovered rules or trading rules in particular by data mining, by going through the data itself. Nobody tell them that this is a rule. And so machine learning is kind of an AI, one kind of AI. Nowadays, nobody think of expert systems as AI anymore. So when you say AI, they automatically mean machine learning because everybody now recognize that expert systems, they are not intelligence. They are not artificial intelligence. It's human intelligence pretending to be artificial intelligence. So now AI and machine learning are therefore synonymous.
Let's quickly move into your fund briefly. So QTS Capital Management. Obviously, we've talked about the tail reaper strategy, but I understand you've also got a bit of a multi-strat approach there. So does that, or you've got a fund that's more of a product commodity pool. You're a CTA as part of a multi-strat fund. Does that speak to your understanding these days that diversification amongst strategies, strategy styles, even markets traded perhaps, is one of the free lunches that we should be eating in the financial markets, that we should be applying as many different strategies, possibly markets as possible, diversifying over different strategy types in a portfolio?
Yes, I think, yes. QTS manages actually two funds. One is a multi-strategy fund, and you might even call it a fund of funds, although we run our own tail ripper strategy in it, but we also invest in other supervisors and other hedge funds. And then there's another more pure trend following fund that is also a fund of fund where we, in that case, we only allocate to outside managers. We don't run our own strategy there. Now, at the very minimum, in my view, a fund need to have a mean inversion strategy and a momentum or trend following strategy. You had to have a long fall strategy and a short fall strategy. Otherwise, you either have a lot of tail risk, or you have a problem of theta decay.
Lumpy.
So you're losing volatility premium. So you don't want either one. You want to have a fund that is neutral to any sort of risk factor, whether it is a volatility risk or whether it is a tail risk or your risk of losing theta and whatnot. So that's you should be neutral to all these factors. And the only way to do that is if you diversify at least into a volatility and a mean inversion component. Now, of course, within mean inversion and within trend following, you can have trend following in many different instruments, futures or your options and whatnot. So you could diversify within the each category. But at the very minimum, you need two components, and that's what we try to achieve.
Is there diversification across product classes as well, like different markets? I presume it is all futures because you're a CTA, but different managers focusing on different markets, or not necessarily?
Yes, they do focus on different markets because, like I said, even within mean inversion, you can implement it many ways. You can implement it using options. You can use futures. You can use stocks. So yeah, we try to cover the whole range of asset class. We have one fund that trade nothing but nat gas. And then another fund that trade, at least originally, trade nothing but agriculture futures. And yet another manager that trade nothing but stock index futures. Stock index options. And us, we only trade stock index futures. So yeah, we have specialists in each category, and but they can broadly be categorized as mean inversion or trend following.
And the managers that you select, are they ones that are also experts in these machine learning techniques, and you share that in common, and that's why you like them?
No, actually, very few of them. Our managers are particularly strong in machine learning or using machine learning. Maybe they are, but they're not telling us. I think that we allocate to them because they have a defined risk return profile. They have a defined factor risk, and we know how to neutralize them based on our allocation method. And in some of these allocation methods is based on machine learning for sure.
Great, Ernie. Really interesting. We've only got like 5 minutes left, so I might quickly throw in some questions that have come in as well. One from JJ. So he's asking about alpha decay. You've talked a lot about the issues that we're all facing in terms of the difficulties of extracting alpha from the markets. Really is a factor of the fact that that alphas decay, that regimes can shift, that there's a low signal to noise ratio. And so he's asking, I guess, how long potentially do we expect a strategy to last, and how many years back should we test an alpha on, before trading it? Because maybe too long is irrelevant. And then, are you able to sometimes keep these strategies as they decay? Can you keep them going by tweaking them, or are the alphas gone forever?
Yeah, let's tackle the last point first. Yes, indeed. One way to tackle the alpha decay is to tweak the strategy. So, if you talk about the tail ripper strategy, if you trade the original version, it won't work anymore. And the only reason it keep working is that we have practically every year we have some additional bells and whistles that we add to it. Sometimes machine learning, sometimes other insights. And so yes, alpha decay is it can be slowed down by tweaking or optimizing the strategy as time goes on. And in general, strategy that has large capacity have a more severe alpha decay because all the big funds are crowding it. Strategy that have low capacity are less attractive to big funds, and so typically have slower alpha decay. But that's just in general.
If we've got a design-led approach too, presumably we would have some consciousness as to when and why that design may break down. And if it's fundamentally still there, then perhaps the tweaks are really what we need to do to fix. Like you've got a momentum strategy there. Presumably momentum's not going away in a hurry. Trends aren't going away in a hurry. So there's probably a tweak that can, or further analysis that we can do, because it's not just a purely machine-driven model.
Yes, that comes back to the advantage of causal models rather than data mining model or AI models. There's another point that was I mentioned is whether backtesting the strategy for a long period of time will let you be more confident that there's no alpha decay. Actually, the strategy that survive well over a long period of time typically have a lower Sharpe ratio because they already decayed so over the long period of time. And also, I don't think that it's necessarily good to have a strategy. There are different strategies that work in different market regime. There are strategies that work very well in the pre-financial market regime, and others that work after the financial crisis. So I think one should not, take the view that I need to find the holy grail where I will retire on this strategy. That doesn't work. You have to be in a state of constant reinvention. You have to find a strategy that constantly finding new strategies that work best. Could be crypto, could be commodities, could be whatever currency. Find something that works now, not 20 years ago.
Well, that's one of Carlos's questions, actually. Do you do any crypto trading? And says, how would you factor in the perpetual futures basis / funding into the modeling, and where do you get data? Have you got any good crypto data recommendations?
So we have in PredictNow, actually, we have looked at crypto strategies for a while, but then we find out that most of the time the larger customers want to focus on TradFi, so we revert to TradFi. So we have done research, but that was based on sort of market microstructure signal. So we look at it at a fairly 1 second intervals, and where we're developing strategy based on the order book and so forth. So I think there are certainly lots of opportunities in crypto strategies, but I wouldn't say that we are experts in that.
Do you recall any good sources of crypto data?
Well, most of the people, what we did is, we were just downloading a lot of order book data from Binance.
From the exchange,
just directly from the exchange, yes.
I think when I was looking at crypto data, I can't really remember. I looked at a lot of data options, including obviously directly from the exchange. It's nice to have it aggregated sometimes because there's so many exchanges and they trade different coins. And I vaguely remember two that I think were good, which was Polygon.io, and another one was called Brave New Coin, two that come to mind. Carlos also asks about, if you're doing this, current process and criteria for pairs selection in statistical arbitrage of stocks.
Well, I mean, the question is, really, how do you determine that there is a relationship that are not, just accidental between two time series, right? And that's there are many so-called linear methodology that people have discovered, such as CADF tests and so forth, to decide that, or you can run it through the Austin-Uhlenbeck formula to see if the half-life of mean reversion is short enough for your taste. But nowadays there are, of course, also non-linear methods, because there sometimes these things would diverge for a while and then suddenly come back after some trigger. So how do you detect those? Again, you have to you can adopt a machine learning approach to discover this kind of non-linear codependence. You have to find some latent factor model to discover if there's a hidden relationship between them that will find them. So there are many methodologies, but I would say that the newer non-linear methods is worth exploring.
Speaking of stocks, have you looked at single stock futures at all? Are they on the radar?
Not so much. We tend not to trade single stock strategies, whether they are futures or stock. And the reason is that it's oftentimes a question of the of data and the inability to short certain stocks that have held us back. So a lot of times when we discover a good strategy, long short strategy, we find that in actuality we could not borrow the short. And those strategies won't work when the stock has single stock futures. Believe me, because those will be so they don't exist in the liquid stocks where you can build single stock futures. Those arbitrage opportunities only exist when the stock you barely can borrow them. That's why we find that for us it's not the most fertile area, because even though we cannot borrow the stocks, other people can. Large institution can, and that put us as a disadvantage.
Yeah. Ernie, I know you've got to run, so I want to let you go. I want to just say thank you so much once again. There's so much to cover. It's actually a little difficult to know how to do it in a sensible order and tap into the just the many years of experience you've got there, especially in the AI ML space. On your personal website, epchan.com, you recommend some books, and you've got your own books. Can you mention other books as well as yours that might be a good starting point for people to continue to learn about machine learning and finance?
Well, one of the go-to books these days for applying machine learning finance is the book by Dr. Marcus Lopez Prado, the Advances in Financial Machine Learning. That's a good start. And but after I read that book, basically I charted my own course by learning more about machine learning and deep learning, and thinking about how they can be applied to optimization problem in finance. So but I would recommend that book as the start.
And you've got a couple of courses or 3-module course on your personal website. Can you tell us really quickly what that would take the student through?
Well, the life cycle of trading strategy development is basically how do you start from scratch in using machine learning to trade. It goes with the most important thing, which is data and feature engineering, to selecting the algorithms, and then finally to implement the algorithm in a live trading strategy. But then there are other courses that focus on particular techniques such as momentum trading, mean reversion trading, high frequency, medium frequency trading, or options trading. So they are specific courses that are not machine learning based, but life cycle is the main course that take a data, AI approach.
Do you focus on a particular software? Do you have a preference for, say, Python versus R?
Well, I often prefer MATLAB because it's a very polished platform. But in this day and age of ChatGPT, really, if you can program in one language, you can easily translate to a different language. Programming language becomes unimportant. Use whatever you feel like it. Learn it from anybody, Python, R. And if you like to use MATLAB, easily translate back to MATLAB code. I've explained that actually in my most recent book, Generative AI for Asset Management, that how easy it is to convert back and forth between Python, MATLAB, R, and so forth.
They do have some different capabilities, though. Is that correct?
I would say they are, more or less the same. There's a particular advantage in one versus the other. It's just personal style.
Yeah. Python's made a lot of advancements, I guess, over the recent years in this area.
Oh, that's because it's open source, so a lot of people can contribute to it. Whereas MATLAB is more like a walled garden. But then walled garden has its virtue, just like Apple. It has very polished code and very easy to use. Much more easier much easier to use than Python, I might add,
Right.
for someone who is not a professional programmer.
Mm-hmm. All right. Well, we'll let you go. I'll put links to all your contacts, obviously LinkedIn and Twitter, your personal website. PredictNow.ai is the business that we talked about that sounds absolutely fascinating, how to apply machine learning techniques, in the risk management, capital allocation area, analyzing your own strategies. I love that concept. The website, of course, for the fund, qtscm.com. But I'll put all the links to those in the show notes. Ernie, thanks so much once again for hanging out, and the developments are happening thick and fast, and stuff that you're working on sounds ever more exciting. So I'm glad you've stuck with it for so long.
It's my pleasure. Thank you for inviting me. Thank you.
We'll talk soon. Thanks,
We should
Ernie.
remind you that the conversations on this show are informal and for entertainment purposes only. Certainly any general advice you may hear is obviously not specific to your needs, goals, or objectives. So nothing discussed on the show should be considered as investment advice. If you want that, you'll need to actually do your own research and speak with your financial advisor. Remember, trading can be extremely risky and past performance is not necessarily indicative of future returns. If you enjoyed the show, please subscribe or leave us a review, and if you have any questions or feedback, we'd love to hear from you. Bye for now.